Let's see if Intel is a potential value play. So here we are in Intel, open it up. Guys, it's down from a 52-week high, 57, down to 35. That means nothing unless you know what's behind the numbers. So let's take our 8-pillar process step by step from here. If you have the software, please follow along if you're part of our community. If you don't have the software, check it out, everythingmoney.com. It's pretty incredible. So pillar number 1, we want the 5-year PE ratio to be under 22.5. So on our main page of our software, it's right here, 7.6. That is a check mark. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. So again, on our main page, right here, 10.3%. Also a check mark. All right, so far we're 2 for 2. One thing to note, the dividend yield is about 4%, and they're paying out about $5.7 billion in dividends, and last year's free cash flow was $10 billion. Their historical free cash flow has been about $20 billion, but they did announce they're going to do massive investments in major plants, one of which is just an hour and a half down the road here, a $20 billion plant in Columbus, Ohio. So pillar number 3, we want the revenue growth in the company over the last 5 years to be positive. So we go to our software, we go to the income statement, we load it up, and we go to 5 years ago, 64 billion, last year, 77.7 billion, check mark. Not huge growth, but growth nonetheless. Pillar number 4, we want net income growth over the last 5 years. So we just merely scroll down just a little bit further. 5 years ago, they did 11 billion. Last year, $25 billion in profit. So for a company that's dying, it's got a lot of profit in there and the profit's growing. Pillar number 5, guys, we want shares outstanding decreasing. Now, obviously shares outstanding decreasing isn't always great, but in undervalued companies, you want the people taking the cash flow and rewarding the investors who stuck with them. That's what happens when you're buying back shares. You, as an investor, are keeping the number of shares you have, but now the profit and revenue is being divided by less and less shares over time, and you're getting a bigger and bigger piece of the company. So 1, 2, 3, 4, 5. This is the 6th year. End of the 6th year, they had 4.7 billion. Last year, 4.08. So that's a check mark there. Shares outstanding are decreasing. Now, pillar number 6 has to do with debt. Now, what we found is we want to make sure that debt is manageable. So what I've done is I go back to the main page. I look at our 5-year average free cash flow of 14.25 billion. I multiply that by 5. We get $72.5 billion. We want their long-term liabilities to be under $72.5 billion. All right, so we scroll up to the top, we go to the balance sheet, then we go to the bottom of the balance sheet, and the total long-term liabilities are $44 billion. That's much less than the $72.5 billion. So they can pay off their long-term liabilities very easily with their free cash flow. All right, pillars number 7 and 8 have to do with free cash flow. So what is free cash flow? It's probably something you've heard a lot. In fact, it's a very high trending search right now. What is free cash flow? Free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. You can buy back shares, pay down debt, pay a dividend, invest in yourself, or make acquisitions. You can do any of these 5, 1, 3, any combination, none of them, it does not matter, okay? Now, on our statement here, we have cash from operations and capital expenditures. We added this line to make it easy for our software users. So 5 years ago, 11.8 billion, last year, 9.6. Remember, look at their change in capital expenditures, though. It drastically increased. So that's another thing to keep in mind. So it's actually an X here. They've actually had a decrease in their free cash flow. In our final metric, we want to take their 5-year average free cash flow multiplied by 22.5. Just like the earnings, we want to see what price for the company we paid based on some sort of multiple of free cash flow. And since earnings and free cash flow should be very similar over long periods of time, we multiply by the same metric. So 14.25 times 22.5, that is 28.5, another 2 is 31, 3, so call it $315 billion. I don't know the exact number, but let's do the math here real quick. Let's pull up a trusty calculator. Oh, 320 billion. I was pretty close. All with my mental math. Aren't I smart? So let's go back to the main page and see where the current $148 billion, guys, less than half. So we did a lot of math here. If you're new to the channel, I'm Paul. I do this all the time. This is what I love doing. I've broken down companies into their financials to understand better what they're going to do. When I see companies like this falling and I see maybe a disconnect, it's a potential value play. I have made this easier for everybody. I go to the 8 pillars tab, and guess what, guys? Remember what we did? I said everything was a check except for cash flow growth. That had dropped. So it's 7 of the 8 pillars. Does that mean you go out and buy it? Hang on a second. Just relax. That's why we made the stock analyzer tool. Stock analyzer tool was specifically created because the future is unknown. But what every investment is the present value of all future cash flow. So we need to make assumptions about the future, and based on those assumptions, it'll tell us what we should pay for the stock, not including the balance sheet. So first line, I'm doing a 10-year analysis and doing 3 assumptions. Revenue growth is the first growth metric. So over the last 10 years, it did 4.3%. My goal is to be conservative. conservative. So let's assume 2, 4, and 6% profit margin. They've averaged 23.6 over the last 10 years, 26%. So I'm going to go 22, 24, and 26. Now, I'm not going to include last year's profit. Why? There was so much demand last year that the margins were increasing. The chips were all in such demand. Everybody was charging bigger and bigger fees and getting the money. Free cash flow margin. Now, I'm going to do 18, 19.5, and 21. Now, before I get into my PE assumptions, if you've watched any of our videos in the past or you're new to it, this is our software. It has been a game changer. Over 12,000 people have signed up for our software. They're in our community and they're engaging every single day. They see exclusive video content from us. They can ask us questions. We engage all the time. But more importantly, a community here based on people with like-minded thoughts about investing. They don't view the hype as something to follow. They sit there and say, any stock is a present value of all future cash flow, and you're buying a piece of a business. If this makes sense to you, this software, along with everything on the main page and the more exclusive content and the 8-pill portfolio and the stock analyzer, the retirement calculator, everything here is available for less than a cup of coffee per day. If you follow this sort of process fully, this can lead to hundreds of thousands, if not millions, potentially in retirement. Is it worth less than a cup of coffee per day? Absolutely is a no-brainer. 2 ways to sign up: everythingmoney.com and patreon.com/everythingmoney for international folks. Guys, the software is growing every single day. It's getting better every single day. People are joining every single day. This is an absolute no-brainer. Please sign up now. Now, for those PE assumptions. PE, I'm going to go 12, 14, 16. Guys, I'm going much higher than the current PE. Why is that? Well, because I think this is a fluke year, fluke profit. I don't think that's going to continue on, but even then, a company like Intel should not be a 6 PE. It's not a dead company. And I'm going to do my 12.5% return. Why? Because I can get 9 or 10% by investing in any market-based ETF. So to give myself some margin of safety, the reason to buy the stock, I put 12.5% in. I hit the analyze button. The stock is currently at $36. All right. Well, it's basically there all day because the only red is $36. So what does this say? Does this say go buy the company? Pump the brakes. Hang on. What this means is you definitely need to do more research. Go to that community. Have the conversation with people who've read the 10K, who've read articles. Go Google. Go find out more about the company to see if you want to buy it. I look forward to seeing you in the community. Please like and subscribe to the channel. Thank you very much for your time.